I think the biggest mistake, and this doesn't matter if you're the seasoned investor or if you're the brand new investor, is what is your goal? And the goal for someone who's young is going to, of course, be different for the goal who's someone who's 65. What's your criteria? Okay, some people call that a buy box, but like, what are you going to buy and what are the metrics associated with that buy? And do you have an action plan put in place for you to be able to hit that goal by a certain deadline? What happens is people go, I want to be a real estate investor. I want to do this. And yet we don't create how we're going to do it. We don't create what we're going after and when we want it by. And I think people would be a lot more productive if they simply put some criteria to it. So make a plan, work the plan. The next thing that happens, so item 2 on this list, is they don't shift their goals or their model as the market or the economy changes. 2017, 18, 19, great time to flip. Going in this up market, all of a sudden the market started really overheating in 19, 20, 21, 22. Ignore the whole COVID thing, just pretend it didn't happen for a second. I'm talking the hottest parts of the market. The market was so hot, you couldn't acquire a flip cheap enough to make money because everyone was just overpaying. Even though the economy was doing good, the real estate market at that moment had shifted to such a high degree that flipping did not make sense. So you've got to be willing to change your model with the times, change your model with the economy. 3, and this one is a very big mistake. We don't review our income, our expenses, and then let's call it the headache or the pain and suffering quotient. Everyone that I meet, unless they're hardcore, and I'm talking this is 5% of real estate investors, they underestimate their expenses. They don't go through and they line item everything and then go through and create it as a percentage. You need to be running the property for less than 25% of the total income. So most net operating income should be about 75% of total revenue. If your expenses are above that, you need to ask why. You also need to look at how consistently is the revenue coming in. It doesn't matter if it's a single family, an office building. Do I get my rent on time, paid regularly? And then last, and we've just kind of developed a 1 through 10 system, with 10 being this property is a freaking pain in the ass, and 1 being this thing is awesome, I never have to deal with it. If a property is making me really good money, but it's a 10, it's a massive pain, and it's maybe not in the best neighborhood, I may need to think about selling that and moving that asset into an asset that's just less headache. See, when you own 1 real estate investment, it's fine. When you own 5, it's starting to be okay. As you start to turn this into an actual business and one of them is dragging you down, you need to reduce friction as fast as possible. Otherwise, your portfolio stops growing and your overall return. So you have to reduce friction. You have to reduce headaches. What happens as investors, and I'm guilty of this, is we get emotionally attached. And we're like, oh, but I love that property so much on Casino Road there in Everett. The reality is it's in the ghetto, okay? And it may make a good ROI, but you may not feel safe going there. And it gets crappy tenants all the time, so just get rid of it. Next on the list is we don't review our loan terms. A lot of these mistakes I'm also guilty of. So you learn as you become this real estate investor is that all of a sudden your 5 years is up and the note was due in 5 years. Your 7 years is up. All of a sudden it's reset to interest only. All of a sudden its interest rate has increased. So what we've learned to do is we keep a spreadsheet of basically the original purchase price, the rent, how much we've raised the rent over the last year, what the deposit is, what the interest rate is, when the note is due, so that we can look at all of our properties together and look at it on a monthly basis. Because what will happen is you will literally miss these things. And all of a sudden you'll look at your spreadsheet just randomly and you're like, oh my goodness, in 6 months, this note is due. Like, I've got to do something now. I've literally had it happen where it was in 60 days. It's like, holy cow, we got to start the refinance today. Number 4, we get comfortable. Comfort is the enemy in just life. Comfort's the enemy in real estate investing. And so what happens is we get comfortable because we went and bought our 4 duplexes and now they make cash flow and they're not being a big hassle. So we get lazy. We get lazy in multiple ways. We let the equity build up and we're not constantly pushing it so our return goes down. Depending on your goals, like we had talked about earlier, there has to become a point where you review the property and you say, this now has enough equity for me to sell this duplex and exchange it into a fourplex for me to get a higher return. Your property will not have a consistent return over its life cycle. Generally speaking, it will go up to a certain point and it will peak, and then it will just start to decay after that. That could be based on maintenance, that could be based on interest rates, that could be based on rent growth, based on the neighborhood, whatever it may be. Also, when you get a few of them, you get some cash flow. You're feeling comfortable. I have some basic living expenses taken care of. So you take your foot off the gas. The thing to understand, though, in real estate investing is if you're not growing, you are dying. Especially now in this high inflation environment. So inflation, even though the government said inflation, it only hit like 9%. Inflation for us real people was like 15%, 20%, just astoundingly high. Well, that means if my real estate was not performing at a high level, I was losing money in that moment. And now with inflation being 5%, if my asset's not performing at 6%, 7%, 8%, it's not performing high enough relative to inflation. So we kind of have to naturally check ourselves, but we also have to think about our goals. So if you're in the latter part of your real estate investing career, part of it will be to de-risk, pay down debt. You won't be accumulating as much. That's okay. But at our age, it should still be gas on, it's game on like Donkey Kong, let's rock and roll, just keep buying. These last two, unfortunately, I think are the most important, and these are the biggest problems. Analysis paralysis. In real estate, I've met many investors. They're getting ready to get ready to get ready. And they've got a spreadsheet, and it's not quite perfect, so they just don't pull the trigger. By simply taking action, you will get further ahead than the person who doesn't take the action. Don't be stupid. Make a conservative judgment. Have cash reserves, protect yourself, but don't get stuck in analysis paralysis to the point where you make no investments and you do nothing. Okay, last but not least, number 6. Investors think they have to have money to buy real estate. OPM, other people's money. If you have a deal, someone else has money. Your job is to find a phenomenal deal. And if you don't have the capital, find a partner. So also don't be greedy. Let the partner win with you. Give them a phenomenal deal. Go do a second deal with them. Go do a third deal with them. And then over time, maybe their returns slim out a little bit. Or over time, you make so much money off that partnership that you no longer need them. But allow them to win too so that they want to do a deal again with you. The most important thing is finding the deal, not having the money.